I really hope I'm better from this cold, flu, Ebola. I'm not sure what I had, but I really hope I'm better for the weekend because I don't want to have to change my weekend plans. So, I read something about how the gold ETF is no longer one of the top 10 biggest ETFs. A few years ago, GLD was the biggest ETF they had. It was the biggest, like the most holdings or whatever, the biggest. Now it's not even the top 10. So, does this mean I think this is a good thing. I think that what happens when something gets overheated like gold, the ETF representing it gets overheated as well. So GLD, the biggest ETF, if not even the top 10. Now, the question I'm wondering is for when gold bottoms, will it fall even lower? Like it'll be not even the top 20 ETFs? I don't know. Maybe that question isn't even relevant. But I thought it was interesting because I saw this like on a Yahoo News kind of mainstream thing. And the tone of the article was like, oh yeah, gold, not even top 10 ETF. I was like, okay, that sounds good because I think you want to be buying stuff that Yahoo News is dissing. I think if not Yahoo News is dissing it, then that's probably a better time to buy when Yahoo News is saying this stuff is great. So that kind of gets you thinking, where would the price of gold have gone if there was no GLD? Where would the price of silver gone if there's no SLV? If the only way to invest in silver over the last 10 years was to buy this metal, right? Where would it have gone? I think that everybody would have gotten a lower price on silver if they had bought if there was no ETF, and that it would not have gone up as much. And if it was down, it wouldn't be down as much. And I'm going to relate this to other markets, like the stock market, right? I mean, how high would the stock market be if people bought stocks and held them for a long period of time? This is what I mean. When somebody opens up a business, their idea is not to open up a business and sell it next week. I mean, I'm sure they'd like to if it went to the roof, but in reality, people open a business and they have a business plan for years to come. They're investing their capital in their own, what they do. Now, when it comes to the stock market, it seems, based on the volume, that people are buying and their window is selling in days. What would the stock market be if when you bought a stock, there was a condition that you have to hold it for a couple years, right? Let's say that there's some new company, or Apple, right? Some new Apple-like company that has some new technical gizmo. And they're like, we're going to go public, but the condition is that when you buy this stock, you can't sell it for at least 5 years. You have to hold on to it for 5 years. Now, if that was the case, if the stock market was that way, what would the price be? Would the stock market be where it is now, or would it be like a lot lower? My personal opinion is that if the stock market was a more buy and hold thing, it would be a lot lower because there'd be less volume and there'd be less trading. That's my opinion, right? And I'm not saying my opinion is absolute truth, but that's what I'm thinking. So, that being said, like say with bonds, like the bond market, right? In normal life, like when someone wants a loan, because basically a bond is a loan. A bond is, you got someone, they need money, right? You got a government or a corporation, they need money. So they issue a bond, which means they say, give us some money and we'll pay you back. That's what a bond is, right? You know, the government says, you know, they sell their treasuries, the people buy them, and they got to pay them back, and they get it, right? So what would happen to the bond market if it was like a loan where the person who bought the bond couldn't trade it? The person who bought the bond was the person who redeemed it later. So if a corporation or a municipality issues a 10-year bond and you buy it, you've got to hold on to the bond for 10 years, right? Where would the bond market be? I mean, I think a lot of these traders would not be in this bond market, right? I mean, the whole point is to hop in and out of trades very quickly, and that's a lot of the volume. That's kind of like an overall question I have, or thought I have, because it seems like our markets right now, a lot of very high volume, with like quote no loyalty. No one thinks of a stock as a business that they're gonna hold on to like their own personal business. They see it as something that they're gonna hop in and hop out of it many times, and they're not gonna actually care what happens to the company, right? It's like people. I mean, when I see a lot of people trading, whatever, it's their idea is to buy something and sell it, and they don't, in the long run, they actually could care less about the company itself. Whereas the people I know who have business, they care about the business. They invest in their business, and it's a matter of years, and they care about it. And the stocks, I don't think that anybody trading this markets actually care. They might say they care, but their actions are otherwise. Their action is they'll abandon their stock at the first sign of trouble. And that's how most people are in all the, I mean, that seems like it's the zeitgeist. I don't mean the documentary. I mean, it's the spirit of the time. The spirit of the time for investing seems like there's no loyalty. People hop in, hop out, and that's how it is. I think with this metals too. Is that's how I think a lot of people on YouTube who own the physical metal, their idea is not to hop in and hop out. Obviously, with the premiums on this stuff, it doesn't. Hopping in, hopping out on the premiums is not the ideal thing. But for people who are buying this stuff, you are in a market with people who are hopping in, hopping out, and the price is going like this, and that's the current spirit of the time. And will that change in the future? It could. All right. Talk to you later. Be well, and I hope I get well.